Hello and welcome to the Real Economy with a focus on the middle markets and the economic headwinds facing it. I'm Gigi Stone Woods, your moderator, and I'm joined by the one and only Joe and Neil of the Joe and Neil Show, Joe Brusuelas, RSM's chief economist, and Neil Bradley of the U.S. Chamber of Commerce. You two have just done such a great job at helping us navigate through these uncertain times, and now we are facing more head scratching than ever. There is so much uncertainty, and the big headline is tariffs. So what are we supposed to make of everything that's going on? And most importantly, how are these tariffs impacting U.S. businesses?
Well, I think that the considerable political uncertainty out there on what's going to go on via trade is caused an extreme version of risk avoidance. Meaning, right now, firms that were going to take big risk in terms of ordering more equipment, software, purchasing more intellectual property, are likely postponing that now, right? We've reached the point where they probably pulled forward as much as they could to avoid taxes, and now we're in a period where they're going to have to wait until they know what the rules of the road are before they engage so that they can think about what the cost of doing business is.
Yeah, we need some visibility.
That's right.
Joe just described one aspect of this, which is the uncertainty. And so there's lots of ways to measure that. There's an index that the Fed tracks, the St. Louis Fed hit a near all-time high. We're talking about 2008 financial crisis levels of uncertainty. The other aspect and impact of this is the real-world economic impact. And so we've had lots of threats of tariffs, but we've already had some tariffs kind of go into effect. So we're now 20% increase in tariffs on China. We have the 25% tariffs, 10 for energy, on non-USMCA compliant imports from Canada and Mexico. There's a lot of products that come in outside of the USMCA rubric. By the way, they were coming in duty-free before. They're now facing 25% tariffs, steel and aluminum. So we've had a lot of input costs that have immediately shot up. And you're already having U.S. companies and consumers who are feeling that. And now we have retaliatory tariffs. And so whether that's motorcycles, alcoholic beverages, things that we make and sell a lot of into Canada, into Europe, you're having these retaliatory tariffs that are suppressing their sales. And then, those impacts kind of collectively then contribute to even more of the uncertainty. And you get into a vicious cycle that points you nowhere but down.
So we're going beyond trade war.
In many ways, we're in the first stage of this.
Yeah.
Consumers are feeling this right now at the checkout counter. We can now see it in the data. Then the second stage is it will begin to show up on the balance sheets of firms who then have to make the difficult decision on how much of it will they eat. That's margin compression, less revenues, less profits, right? And then what do they pass along? And then we'll get the second order effects. And we'll see that over the next 90 days. It's going to show up in the data. It's going to materially affect not just the growth outlook, but the employment outlook and, of course, pricing. And that's really where I think we want to be careful, because I'm not certain, actually I'm fairly certain that the public's not yet recovered from the previous price shock. And the fact that we're having another intentional one in order to reshape the terms of trade, this is where I don't think the public's going to react well.
Joe's excellent point on this about innings, and the way to think about this is right, because to the extent you'll hear some people argue, well, we're going to have an appreciation, a strengthening of the dollar that'll offset some of this tariff price increase, and so there'll be amelioration. Okay, yeah, dollars tend to appreciate when you're applying tariffs. But then, okay, what are the order effects of an appreciating dollar? Well, all of a sudden, our exports are now more expensive. So folks who are buying the stuff that we make are buying less of it because we've made it more expensive with the appreciation of our dollar. If you're a company that happens to operate and make money outside of the United States, you want to bring that money back, an appreciated dollar means what you've made is just worth a little bit less when you bring it down. That begins to show up in kind of corporate earnings. And so you have these impacts that once you start down this road, they kind of keep compounding.
And for our service-based firms out there in the audience who may not have exposure to the external sector, yesterday we saw a 200% tariff put on all imports of European wine. Okay, if you like European wine, that's fine. You can substitute to California Chardonnay. But what happens is over time, that supply dries up, then the price of California Chardonnay actually increases. That's a good way to understand why trade wars are the classic lose-lose proposition that they are.
And where do you see inflation going? You touched on it.
So if the administration implements what they said they would, we expect instead of a 2.3% level of inflation this year, we'll be at 3% with upside risk. And we'll just have to wait and see how this all evolves. And that's really, at the end of the day, the problem is we don't know what the rules of the road are. And so what that does is that causes me as a consumer to think, maybe I ought to just wait.
Either way, or you have these expectations, right? So if you look at the University of Michigan survey, monthly basis, your inflation expectations, we saw the largest jump in something like 40 years between January and February, 100 basis points, full point increase in people's expectations about where inflation is going. They've been burned by inflation in the past. They are super sensitive to this. You have to expect that they're going to be making immediate decisions today if they have that expectation that inflation is going to be that much higher in 6 months, and that can become its own self-fulfilling prophecy for the economy.
That's really the latest news, consumer confidence taking a nosedive.
Yeah, 1 year inflation expectations jumped to April 22 levels. All of the progress that we've made on this since April 22 has just been erased in the past 2 months. That's really hard to square, but that's what the public is telling us, and we have to take that seriously.
Very seriously. Speaking of asking the public, we did a poll where we were asking our viewers what they think on a matter of topics. Are you pulling back on hiring due to policy uncertainty around tariffs? So most of them are saying no.
Right, and that makes sense. That's usually going to be the second order effect, that you're going to wait on hiring. We're at full employment. The unemployment rate's 4.1%. Full employment's around 4.3%. So we're a little tight, to be honest with you. There's not much more to be done on hiring, and people are going to carefully manage firing. But should you see a further slowing, then that's what would occur. Remember, we all love the jobs data every month, but it's a lagging indicator.
It's exactly right. But what I really look for is where the trend lines in this moving, right? And so, yes, of course, we have more people saying no for exactly the reasons Joe said. But if you look back at the RSM Chamber surveys of mid-markets on expectations, the mid-market has been incredibly bullish about their hiring plans. Almost no one in the middle market is saying that they intend to reduce kind of headcount. And so even more so than larger companies who've been much more indicative in recent surveys that they intend to reduce headcount. So when you see that little bit of movement there, that's telling you that the direction of travel here is to be a bit more pessimistic about their future plans, even though, thankfully, a majority still say no.
So far. Are you pulling back? This is our next question that we're asking them. Are you pulling back on capital expenditures due to policy uncertainty around tariffs? And still, a slight majority of them are saying no so far.
And this is encouraging, and it's why I think it's completely premature to be using the R word with respect to where we're at, right? Growth's going to slow in the first quarter, and that's fine. It's just a late cycle slowdown. However, I want to put this out there to everybody who doesn't follow the data flow. In January, we saw a 33% increase in the import of industrial supplies. That's a $23 billion delta. That's the biggest I've ever seen. Now, 60% of it was non-monetary metals, mostly gold. There are big companies out there who have seriously pulled forward orders. And that's going to cause the trade deficit to widen, which is actually antithesis of the goal of policy. They want it to narrow. And as the trade deficit widens, it creates a greater drag on GDP, which is why you should expect to see a slower pace of GDP, but again, not a recession. And having been an economist at a firm now for well over a decade that specializes in the mid-market, what you're hearing is classic mid-market behavior.
So where do you see GDP going?
It's solid, it's steady, and it's not going to panic. It's going to wait. Now, should they see the whites of the eyes of the import taxes, then in the next quarter, you'll probably see that reverse. There will be a big move. But hopefully, we find the rules of the road soon, and they're not as bad as we might think, and we'll all make that adjustment together.
All right, our next question. Stands to reason. Have you pulled forward orders to avoid the imposition of tariffs?
did.
Still the majority saying no, so another good sign.
Right, but in a normal situation, this would be 100% no, right?
That's
So
a
like,
good point.
so this is the thing. Yeah, of course, not everyone is pulling forward orders, or even the majority. You have to have the wherewithal to be able to do with that financially.
Yep.
You have to have suppliers who can actually meet that. You got to get a lot of things right. The fact that you have this many people who said, "Yep, I pulled forward orders, and I was able to do that," tells you something that's going on here that's going to lead to the implications that we just discussed.
Again, I want to restate this, that mid-market companies or mid-sized firms with big company problems, usually without the capital depth. That's why I mentioned that $23 billion delta. Those are the big companies moving quite quickly that do have the capital depth. So we'll want to see what happens going forward. But that's consistent with what I would have expected out of the middle market.
So the real economy does not disappear that quickly.
No, not at all.
Is there still room for us to get out of this?
Without a doubt. There definitely is. But again, we have to know what the rules of the road are. And the increase in trade taxes can't be onerous or crippling, especially as it applies to the North American integrated manufacturing system. If we start taxing at 25% or greater, the movement back and forth across the border of parts, and your average part is going to go back and forth across the border 7 to 8 times, well, then you're asking for a downturn, right? You really are. So I think as long as we don't end up there, we won't get it.
Yeah, that's exactly right. I mean, you have to, A, get the policy right. 25% tariffs, anything approaching that on the vast majority of our trade, that is absolutely the wrong policy. That's going to be detrimental. Even if you pull off of that, you got to instill some confidence and remove this level of uncertainty. So we can't kind of have this debate every other day, seemingly, about whether or not we're going to have the tariffs or not. And so certainty is important. The certainty needs to be grounded in policy that is supportive of a growing economy. And then we have to get to the other things that can be additive to economic growth. And so we have this major tax cliff at the end of the year. Congress is trying to figure out how to work its way through that. Accelerating that resolution, providing certainty on where we're going on tax policy, that would boost confidence and boost the economy.
Yep.
The administration started its dereg efforts. There's a lot of promise there. It does take time. These are complicated legal processes that agencies have to go through. Moving that forward and keeping that at pace and keeping the focus on that gives more certainty, that is more pro-growth. So there are some things that we should be doing in lieu of the things that we shouldn't be doing, which is this constant uncertainty about really high tariffs.
There was a lot of people, I mean, everyone thought that deregulation was going to be a top priority for this administration. That's not really panning out at all.
I would say it is still a top priority for them. The biggest move actually so far we saw this week out of the EPA. Some of the most costly regs on the energy side came out, about $1.2 trillion in costs, came out of the EPA during the Biden administration. The EPA this week announced that they're beginning the process to revise all of those rules. They intend to revise them by bringing down those costs. But listen, they're going to move fast, but fast is still months, if not years, until final completion. It's going to be subject to litigation. The faster they move, the better we'll be.
One way to get out of this is to reestablish confidence and credibility, not just for financial markets, but for those who operate these firms in the real economy. What we need to hear is full depreciation of investment in CapEx, rather than the intraday tariff rate against Canada, Mexico, and whatever countries designated that day. That's what's really causing the churn, and I think that's what's causing the loss of confidence, and to be honest with you, the loss of credibility.
That's exactly right. And to give the president credit, in his address to Congress, he said full depreciation retroactive to January 20th. My free advice to the administration is I would repeat that every single week and remind people the policy that Congress is going to act is full depreciation, retroactive January 20th, at least remove that aspect of uncertainty and give people the confidence, at least with respect to tax policy, to go make those capital investments.
What advice would you give the Treasury Department right now?
I think that it's very important that they reestablish confidence and credibility amongst financial market participants who were somewhat taken aback and found themselves on the wrong side.
Wall Street got it wrong.
They did. They absolutely got it wrong. It's been wrong now for a number of weeks. I think a focus on forward look around dereg, around CapEx depreciation, and tax reform will go a long ways towards reestablishing that confidence and credibility that appears to have been lost over the last 2 weeks.
It looks like we have avoided a government shutdown for now. So what is the debate in Washington going forward?
We have avoided a government shutdown. I'm pretty confident they'll have the votes. We won't shut down. I think the debate is really twofold. One, it is on the spending side. And even though we're going to avoid the shutdown, there's a lot more debate to come over how the DOGE is working its way through agencies. There is ongoing litigation about what they're allowed to do. Congress is ultimately going to have to weigh in on these budgetary and spending matters. That's dominating a lot of the conversation. Behind closed doors, what's dominating is the resolution on taxes and on the debt limit. And so they really have to figure out the path forward on both of those issues. They really need to do it, by, end of spring, Memorial Day, or early summer. And there is just a huge stack of work that they're going to have to get done, largely behind closed doors, to make that happen.
Where does Congress stand in terms of oversight on trade policy?
Absent. Absent.
Abdication would be a good word right now. They've just basically vacated the space, and that's one of the reasons why we're seeing the volatility across financial markets. We had a question up there about the direction of the economy this year, and we had a pretty healthy split between slow growth, stagnation, and recession. Now, again, it's premature. We think we're going to see 1.1% to 1.5% growth in the current quarter. One of the things we're concerned about is rising yields at this point. When you get the conditions of slower growth and rising inflation, that creates the conditions for stagnation at best and stagflation light at worst. So I think when we see the answers to those questions and you get close to 25 to a third saying recession, I understand that. But we're not there yet. But it's why we need to see a change in course here in order to avoid that, because I could see if this gets worse, there's going to be a general loss of confidence in the commercial crowd, and they're just going to exit.
I bet good money that if we had done that exact same survey with everyone who just participated in it in January,
Yep.
the number one answer would have been 3% growth.
That's right.
And so we haven't had some exogenous shock to the system that's changed that. We've just gone through this kind of period of policy uncertainty and some negative policy choices that have been front-loaded that is driving that reaction that we see today. The lesson from that ought to be that we can reverse that, right? And so we can make choices around policy outcomes and providing certainty and confidence to markets that could get us to the answer that I'm confident we would have saw in January. We just have to make that shift.
Indeed, before all this started, the top line index of our middle market business survey for the first quarter reached an all-time high. The increase was far larger than the first election of President Trump. So that confidence was there, but we can now, in these questions, we can now see as we look at real-time economic data and of course the volatility every day across asset markets, an erosion in confidence.
And ex-tariffs, there's reason to be confident in
Yep.
all those other things, right?
All
And
that's
so I think for some of us, that's the frustrating thing. Is like, there's so many good things. There's so much opportunity here. And we've kind of got distracted for a moment. We need to reorder it to focus on the things that are really powerful in terms of growing this economy.
I think that's it in a nutshell. But you're both regularly speaking to American businesses. Are they feeling anti-American sentiment?
They are. It depends on where they operate. And so increasingly in places like Canada, for example, you do routinely hear stories, not just at the retail consumer side, but increasingly even in B2B, where there is consternation about buying American, doing a business with America. We are talking about our largest trading partner. We are talking about an ally. We have to figure out a way to kind of calm the situation. It is the case that they're in the middle of kind of an election season in Canada. We know from our own election seasons that that can kind of have its own impact on consumer sentiment, but it doesn't change the fact that that's negative for U.S. businesses. And so Canada is an incredibly important market. Some of these other markets are incredibly important to us, and we need to be reassuring that we are good partners, and we are, in particular, good economic partners.
There's no more important trade partner. There's no more important ally. When you look at trade between the U.S. and Canada, we were in a surplus excluding oil. That's why when I talk about lose-lose propositions, we're putting a tax, something we were in a surplus on, that's not going to end well. The reason why we import oil from Canadians is that our refineries in the upper Midwest and Northeast are set up to refine the heavy crude, not the light sweet crude we extract from the Gulf or we do in the Permian Basin. Moreover, we don't even have the pipes going up there to ship it, even if we wanted to. You know, the U.S. and Canadian economy have such a degree of integration that it's essentially one economy with two currencies. The idea that we're going to unscramble the egg seems a little bit antithetical to me. I need somebody to explain to me, how are we going to undo the degree of integration that's been developed over the past 40 years? And taking a sledgehammer to it's not an option. Now, the question you asked, though, I want to answer. Unfortunately, it's not about price now. It's about the Canadians becoming the 51st state. And that's where I think the real problem is. That's going to take some time to repair, right? And that's the unfortunate gist of where we're at. I'm much more comfortable talking about goods going back and forth across the border than I am the politics, especially during the Canadian election season. But we've created a mess of our own making that's going to take some time to repair.
It's not just Canada. In your latest article, you talk about the new mercantilism. Yes. So what do you mean by that?
What I mean is that it would appear the goals and objectives of the administration is to reset the terms of trade and the balance of trade globally back to a time before the 20th century. They're much more comfortable with spheres of influence, a more tributary set of relationships with key economic actors, and a closed hemisphere, right? Now the problem here is that there's an internal inconsistency. If you want to cut taxes, you're going to cause the trade deficit to widen and capital inflows to increase, right? But you're putting tariffs on at the same time, right? So something's going to have to give here. And what I hope's not the solution is that they opt to devalue the dollar, because I think that would be a prime mistake, and that would end up damaging the credit rating of the country. And we'll be in a very difficult situation at that point. So we're awaiting clarity out of the administration. They've got very bright people in key positions who are capable of explaining where they want to go. The markets are going to demand that quite soon.
This is a frustrating thing about a lot of the public debate. I think perhaps a lot of our audience members know it, right? But if you want to attract foreign investment, and we tend to like to celebrate foreign direct investment, these new factories that people want to build here. Well, that's the other side of the coin of the trade deficit. So we're buying things with our dollars from foreign trading partners. They're taking those dollars and they're investing it back in the United States. And they're supporting our equity markets. They're helping build new factories. That is always kind of net positive for all concerned. And we seem to be trying to pretend that those are two separate economic things that are occurring when in reality they're joined, and we should be focused on how we both strengthen that investment and have a vibrant trading relationship.
Total trade balance plus capital inflows equals zero. That's one of the chief sources of the inherent dynamism and resilience of the American economy. We want and need the foreign investment. It's what drives productivity. It's what drives growth. It's a dramatic source of hiring. And it seems to me we need to think this through before we really smash 80 years of trade and security arrangements.
And supports dollar dominance around the globe.
Yeah, that's right. And let me tell you what, the dollar as a reserve currency is not well understood, and it's underestimated, and it's in the reason why we are able to do what we do. It's why we can spend more than we take in revenues, and why we don't pay a premium for it. And I am just uncomfortable putting at risk the dollar's reserve status going forward to get a few more jobs in manufacturing. Because it's to the point where manufacturing is just about 11% of GDP. It's about 4%, accounts for 4% of hiring, all jobs. We need to have a realistic-based discussion around this, because even if we do reset the global terms of trade to where manufacturing does come back, it's going to be highly automated based on artificial intelligence, and it's not going to reset to 1950s employment levels. And that's where I get frustrated when I hear the discussion around this.
Well, particularly when there is an alternative way to boost domestic manufacturing employment, right? And so you can choose to boost it by raising the cost by imposing tariffs, for example, and letting U.S. prices kind of rise to try to meet it. By the way, that means that we all pay more for the stuff we want to buy. Or you can try to make U.S. domestic production more efficient and more competitive in the market. How do you do that? Well, you can have sensible tax policy. You can have good regulatory policy. You can have an abundant approach to energy. It's one of the huge kind of input costs into manufacturing today. You can have policies that take advantage of new technologies. So it's not just robotics and automation, it's robotics and automation now complemented by artificial intelligence, right? There is definitely a pathway here to boosting not only total manufacturing output, but even high-end manufacturing jobs in the United States. And it's just that we need to be focused on that pathway that's through growth, lowering costs, and reducing barriers, not through the tariffs.
If we want to create a framework of incentives for Apple to produce phones here, I'm all for it, as long as we're honest about what the price is going to be and the level of inflation, right? And that's fine. As long as we're honest about it, it's good. The problem with the pathway we're going down now is it's going to kill productivity just as it's starting to soar, right? Neil is spot on. Interaction with the outside world creates a series of incentives that requires innovation and competition. It's a source of why we've rebounded from the disaster we were back in the 70s, when the economy was closed, by the way, and we had all sorts of regulations. We know all of these things, we've been there, but yet it would appear, absent a clear and concise explanation of the policy pathway, we're drifting back towards that. And that's a real problem. And again, that is the primary reason why you're seeing, not today, but the sell-off in the markets over the past month since February 19th, where the S&P 500 is down over 10% and in correction territory. And I want to say to all the middle market firms out there, the Russell 2000 is on the verge of entering bear market territory. And this is something that didn't have to happen. The Russell 2000 is a good proxy for mid-market firms that are largely private. Those firms are public. And it does look like there's a real risk there that it may tip into bear territory. And I don't think that's something that needs to happen.
You guys are making really important and thoughtful points that we're not seeing enough of out there in the media. I want to go to our faithful viewers and their questions that they're asking. Which sectors of the economy show the most positive growth, and which sectors show least positive growth?
Well, if you're looking at the economy as a whole, clearly tech has been the bellwether, right? What's lagged has been manufacturing, and the pathway we're on is going to act as a deadweight on manufacturing in general, and the auto sector in particular, and then aviation second. So those are where I think things are going well, and then that's where the concern is.
Yeah, it's hard for me to look at anything in an especially positive light. It's all relative, of course, and what you're seeing today is a kind of a retrenchment to staples. That's not necessarily a good path to be going down. We don't want to retrench in that direction, even if it's more relatively positive for them.
And I want to add something here. When you get periods of stomach churning volatility in asset markets like we are, you run the risk of creating a negative wealth effect. For a number of years, the upper end consumers have really carried the economy through the very rough patches and the volatility. That's got to do with rising home prices and rising equity valuations or rising asset valuations. Because those are falling and falling sharply, this is the sharpest downturn that we've seen in over half a century. There's a concern that the upper end consumers may slow the pace of their growth or even pull back. The rule of thumb, and I want everybody out there to remember this, for every dollar decline in the stock market, 2 cents doesn't get spent. This goes on long enough, it gets volatile and more intense. You're creating the conditions for what in the English Premier League they call an howler, an own goal. And again, it's something that doesn't have to happen, but we've been so conditioned to this positive wealth effect for so long, buying on the dips for 20 years now. When you see this asset volatility, it does create some concern, and that's why I thought it's important not just to mention tech and life sciences, which are great, manufacturing, which having a real tough time, but who does the spending, where it's located and what its sources are, and we're putting that at risk right now.
So another viewer question is, how would you advise companies to cope with all of the uncertainty created by the administration?
Well, we started the day after the election. I take President Trump both literally and seriously. We mentioned diversifying supply chain lines, get into where you thought the free trade zones would last. Make sure you're compliant with USMCA. Second, we did recommend many of our clients to pull forward activity. One large client who's in the gaming industry out west that's engaged in some construction, they literally tapped credit lines to pull things forward, and they were right, because they would have faced a 25% increase in cost in terms of the steel and aluminum that's going into their products. We're talking to other clients about the North American integrated food supply chain. I really think it's important the administration adopt exemptions for food imports. 50% of our...
We learned that in the past.
Yeah, we have. We know this lesson. But evidently, we're going to learn a hard one again. 50% of the vegetable imports come from Mexico, 40% of fruits. Again, this is just a self-enforced error. It doesn't have to happen, right?
Everything Joe said, and I would add to it, say, because you should take it both seriously and literally, but you should also layer under that, there is uncertainty. He can change his mind, go a different direction. What we're advising our members at the U.S. Chamber is you ought to have a plan for exactly what he has proposed. It doesn't necessarily mean that you make the decision to execute on that plan before he makes the decision, but if you're left scrambling to figure out what you're going to do when a tariff that he's telegraphed well ahead of time is coming into effect, there are going to be lots of people who are well ahead of you. And so this is a thing where a lot of pre-planning and having someone in your organization who is responsible on a daily basis for understanding when the trigger was pulled and when it was pulled back is really important for being able to navigate in real time.
One of the viewers also asked if you think that these tariffs could have staying power in future administrations.
Absolutely. This is why we're here talking about this, because typically when they go into effect, they don't get rolled back for many, many years, if not decades.
Yeah, I mean, the China tariffs from the first Trump administration largely maintained and expanded by the Biden administration. The metals tariffs that we had in place, many of them largely kept in place. The agreements in the Trump administration the first time, they replaced some tariffs with quotas by country. Those quotas stayed into effect. Here's another example that I don't think enough folks are talking about. We tend to talk about product tariffs. Yeah. The Biden administration, in its last year in office, initiated a proposal for a $1 to $1.5 million port of call tariff for container ships coming into the United States if the original ship was manufactured in China or if there was a China Maritime Organization operating the ship. The Trump administration has just announced that they're planning, or they're in the process of continuing to move forward with that. That's about, depending on the size of ship, et cetera, about $600 to $800 in additional costs per container. And so these are things that can start under one administration and easily continue into future ones.
The one that I always like pointing out, because it's so critical to the whole U.S. economy, is housing. 30% of all wood used in construction is Canadian softwood lumber. We have a ridiculous tax on the import of that. Now we've thrown 25% on steel and aluminum, also two key inputs that go into the construction of housing. It's creating a situation where we're short housing. I mean, we're short 3 million homes. And this has gone on since the great financial crisis. So everybody's implicated in this, right? So since we're all guilty, we're not going to blame anybody. There's a viable way out of this, and it doesn't involve increased taxes on inputs. And remember, at the end of the day, 45% of everything that we import are intermediate inputs into the production of final goods here in the United States. It's just a classic tax shock at the end of the day, and that tends to not be rolled back. And that's one of the reasons why we simply don't have enough houses to meet demand. And you would think that's something that governments of both parties would have addressed, but no, that's not.
So where do you see housing going?
We're going to be short housing for a long time. I own 2 homes, Gigi, for a reason. The price is going up.
Just to go back to this continuation, by the way, and you've seen some arguments about reciprocal tariffs. And well, the reciprocal tariffs, maybe that's a way to ultimately bring tariffs down. That's not been our experience in the United States. We got into when Lyndon Johnson was president, we got into a spat with Europe over their reluctance to import American chicken. And we retaliated in a reciprocal way by imposing a 25% tariff on trucks and light-duty vehicles, so little cargo vans, trucks. We still have a 25% tariff that we impose on the rest of the world on trucks and light-duty vehicles from a reciprocal argument over chicken that occurred in the 1960s.
And, you know, a lot of what we eat includes genetically modified organisms. And that's a separate discussion. Mm-hmm. But most of the world, that's not going to meet their standards. We're not going to be able to export our way out of this if we get in a tit for tat over food on taxes.
That's a good point.
Which is why I really think it would be nice if they go out on a beautiful Friday afternoon, the White House, and announce that there's a general exemption for all food imports and exports, and that we're going to get by that.
Take note. Some ideas for you. We haven't spoken too much about interest rates and how the Fed is going to react to all of this. And can the Fed even do anything in regards to tariffs?
The Fed can do nothing about your tariffs. If the economy's slowing and inflation's rising because of tariffs, or just, let's leave out the I word, let's just say the price level is increasing, okay? That creates the conditions for stagnation or stagflation. The Fed gets pressure on both sides of their mandate, price stability, maximum sustainable employment. If you make a central banker choose between lower and higher rates under conditions where you're worried about stagnation or stagflation, you're going to get higher rates. You're going to see next week when the Fed meets, they're going to come out and they're going to sound a little dovish. They're going to admit growth slowing. There's going to be a little bit of risk around employment going forward, but we're not lowering rates anytime soon. You're not getting a rate cut in March, and I don't think you're going to get one in May either. Now, we'll see where we're at in the second half, because the unemployment rate's at 4.1%, and the Fed thinks full employment's at 4.3%. We'd have to see a pretty big increase in unemployment for the Fed to think that there's risk, asymmetrical risk on that side of their mandate. Even then, I'm not certain they're going to want to cut rates until they're certain that this is a one-time shock to the price level that works through for a year and then resets the previous trend. Then and only then are you going to get an improvement in rates. Moreover, yields have been falling not because risk appetite. Yields are falling because there's risk avoidance and worries about slower growth. That's how you get lower yields, but you don't get the economic expansion you normally see with lower yields. And why is that? Trade taxes.
You see it in oil prices too?
Oh yeah, yeah. You definitely can, yeah.
One of the viewers also wrote in and asked, how would you advise a company who's trying to secure financing over the next year?
Ooh.
That's a really good question.
I think it's really fact situation dependent,
Okay.
right? I can imagine situations in my head where there's a really good, strong argument to make depending upon industry, sector, exposure. There are other situations in which you may have a pretty hard time convincing folks depending on your exposure.
When we talk to people about forecast, risks around the forecast, we always make sure we mention the idiosyncratic risks, those things we can't quantify. The idiosyncratic risks around business expansion are such that you really have to get into the micro detail. There may be some cases where the advice is to do this, but wait 6 months. Other sectors, industries, where the capital flow dynamics are such that, no, they want to do this now because the demand's going to be there regardless, because the inelasticity of demand. They're going to just walk and look right through the pricing dynamics, right? And I mean, that's what makes this difficult, though, is you have to get that granular. I'm going to speak to somebody next Tuesday, a company that's impacted by the tariffs. Even I'm surprised by how the granularity of the data that I'm diving deep into to show them where they have to be concerned. And we're just talking about going from the Quebecois to the Northeast. I mean, we're not talking about bringing things from Japan into San Francisco to serve Kansas City, right? Yeah, and that's unfortunately, it's a real life situation.
Another viewer asked a tough question, just where you see the economy going by the end of this administration's term. I mean, I know it depends on so many factors, but I'd be curious to know as well.
Well, you know, we're going to take this 3 to 6 months at a time because of the level of uncertainty that's been injected into business planning and hiring, right? If they follow through on regulation, if they follow through on tax cuts, I see no reason why this economy shouldn't grow between 2.5 and 3. My sense is, and I think the Fed sense is too, that the growth rate has shifted upward. This is what we wanted. We're here now. It would be a shame to miss out on this opportunity. So we'll want to see, you know, we're at the situation where we're going to soon invoke the Pottery Barn rule. You break it, you buy it, you own it.
Right.
Right? And we're in the last 90 seconds, we're pretty close to that point now.
Let me give you an optimistic possibility. The Treasury Secretary, Secretary Bessent, during the campaign, articulated a 3-3-3 plan. 3% economic growth, getting our deficits down to 3%, below 3%. By the way, that means our economy is growing more than our indebtedness as a nation. And 3 million, he described it as 3 million barrels of oil, but really the equivalent of that in new energy production. Those are hard things to do, but they're not unachievable. And if we were to stay focused on those goals in terms of what we could do in boosting economic output via regulation, energy production, lowering there, like we could get to real sustained 3% growth. It's just going to depend on some of the choices that we make and where we're putting energy and where we're placing policy.
Okay, I love ending on a positive note. Clarity is the name of the game, but you all have been so insightful and just really a lot of wisdom in this very uncertain time. So hopefully people will take note. And I just want to thank you, Joe and Neil, Joe Brusuelas and Neil Bradley of the Chamber of Commerce. Thank you for watching The Real Economy.